In this video, we're just going to experiment with Jim Otar's retirement calculator. And what it's designed to do is to help people decide how much money should be in stocks and how much money should be in bonds. And it does that by going back to the year 1900 and taking a look at what would have happened if somebody retired in 1900, 1901, 1902, and the markets just followed the way they did. What would have been the results? So here we've got somebody age 65. They're going to live to age 90. They've got $1 million to invest. They like stocks, so they're going to invest 100% in the stock market, the U.S. stock market, S&P, and they want to withdraw $50,000 each year. So the first thing we can do is just say, okay, how much money can this person really have? So let's click on here. And what we see is that with a 100% stock portfolio, their income is safe if they only take about $21,000 a year. Well, I know we want to take more than that. So let's just change things a bit, and maybe let's take out about $35,000 a year. And now let's go and take a look at our chart. So now what we see is a chart with a lot of lines on it. And what this chart is telling us, what each line represents is a date that you could have retired going back to 1900. The green line represents the 10 best market returns. The red line represents the 10 worst market returns, and the blue line represents the average. And the black line is just the worst. And let's just scroll down a bit here, and we can see that the worst year to retire would have been in 1929. And with $1 million, taking out $35,000 a year, you would have run out of money at age 80. Let's change that a little bit. Let's see what the best year would have been to retire in, the highest. And we can see that if you retired in 1975, you would have ended up, after taking out $35,000 a year, about $10.7 million. So let's change things up a little bit now, and let's go with a portfolio of 100% bonds. And we can see now, looking at our chart, that this person would have had, his money would have lasted until age 87 and then run out at age 88. So that's not too bad. Let's take a look and see what the best year would have been. So here we can see that the best year would have been 1978 to retire, and he would have ended up with about $3.6 million. So that's about $7 million short of an all-stock portfolio, but his money did last to age 87, which is a lot better than where the stock portfolio went. Okay, so we've looked at all stock and all bonds. But is there somewhere in the middle that might make more sense? If I follow this orange line, I can see here there's about a 5% chance with this asset mix that he will not run out of money. Sorry, I should point out there we've got on this side of the scale is bonds, on this side of the scale is stocks. If we look at the purple line, we can see here with this mix, so about 40% stocks, there is about a 95% chance that he's going to receive all the income that he would like. And the optimum mix for this person is somewhere in here, so about maybe 25% stocks ranging up to about 50% stocks. So let's change our portfolio mix to 40-60. And we'll look at our chart, and we can see that this person has full income all the way to age 90. And of course, that's based on the worst year, which is 1937. If we look at the best year to retire, which would have been 1975, he ends up with about $6 million. So I think on the surface, this tool looks fairly good for helping people to decide how much money should be in stocks or bonds.